This podcast includes information provided by the issuer and does not express the views of the interviewer. This podcast may also include forward-looking statements by the issuer that involve certain risks and uncertainties to its business. Because forward-looking statements are subject to risks and uncertainties, the issuer's actual results could differ from those indicated in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT, and you are listening to episode 40. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@SNN.Wire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the microcap message. For this episode of the Planet MicroCap Podcast, I spoke with Jeff Gramm, author of the book Dear Chairman. In episode 22 with Adam Epstein, we discussed at length the importance of corporate governance, not just for microcap boardrooms, but for all public companies. Since that conversation, I wanted to learn more about corporate governance and what should be done in the event that C-suite management and boards of directors aren't acting in the best interest of shareholders. I discovered the best way for me to understand this topic was anecdotally. I came across Dear Chairman by Jeff Gramm on a reading list, and I'm glad I did because it really helped me understand the rise of shareholder activism and the effect it's had on corporate governance. In this interview, you will learn about his background, his approach to investing, and we discuss his book, Dear Chairman. Reading lists are great resources, as I have found, and I highly recommend adding Jeff's book to your list. Thank you again for tuning into episode 40 of the Planet MicroCap Podcast. Please enjoy my interview with Jeff Gramm, but first, a word from our sponsor. Hey everybody, Robert Kraft here, your host on the Planet MicroCap Podcast. I'd like to take this moment to invite you to join me and some of the guests you may have heard on this podcast to our annual MicroCap Investor Conference, the Planet MicroCap Showcase, April 26th through April 28th, 2017 at none other than the Planet Hollywood Resort and Casino in Las Vegas. The Planet MicroCap Showcase will be 2.5 days of company presentations, networking opportunities, an educational workshop, and you'll get to meet privately in one-on-one meetings with company management of undiscovered and well-known microcap companies. There are a lot of surprises in store, and you're not going to want to miss it. So join us at the Planet MicroCap Showcase, April 26th through April 28th at the Planet Hollywood Resort and Casino in Las Vegas. For more information, go to www.planetmicrocapshowcase.com and register now to reserve your spot. See you in Vegas. For this episode of the Planet MicroCap Podcast, I have Jeff Gramm on the program. He is the author of the book Dear Chairman. Jeff, welcome to the Planet MicroCap Podcast.
Hey, thanks for having me.
It's great to have you on. So to start off, as we do with the podcast, what is your background and how'd you get started investing in microcap stocks?
Sure. So I run a fund called Bandera Partners, which is a kind of a concentrated value fund, 15 to 20 positions. Well, really 10 to 15 positions, and we're very small. Like we are under $200 million. And how did I get started? I began my first job in the hedge fund space was at a distressed debt fund, and this was in the early 2000s. And ultimately, if you did distressed debt, then you also tended to look at lots of kind of unlisted equities, distressed equities, post-bankruptcy equities. And I do think there's a lot in common between buying a distressed bond and buying a microcap stock because, both of those markets are very influenced by the dearth of liquidity. And so it was a pretty easy transition from buying distressed bonds to looking at microcap businesses.
So for those who don't know, and even though this is a a MicroCap stock podcast. What is a distressed bond? Just, for out of pure interest, I'm sure some people might want to know what that is.
Sure. So just a bond issue that is either in default or at a severe risk of default. Often they're defaulted or in bankruptcy. And, a lot of the ones that we trafficked in had very small bond issues, like $100 million or $200 million issues. And they tended to be in concentrated hands, and they tended to not trade that much except, in kind of periods of big news, So it was an over-the-counter market, obviously. It's, bond trading. So, so all the trading is by appointment. And the markets were very thin unless there was big news in a name. So it was a lot like you see with microcap stocks, where often the price, was really determined by the actions of a few big holders, and very determined by liquidity.
And how would you say that it prepared you for your microcap investing strategy? Was it because you had to really just dig in and do a lot of more research, and you saw that as a similarity between the asset classes? How did it prepare you?
Yeah, there are two big similarities, right? Like the first is, when you buy a position, there's no guarantee that you can get out of it on any, kind of a dependable timetable. So you really need to do thorough work to be sure that you're right on valuation. And then also, a lot of the trading is just, kind of hanging around the hoop, hoping that some bonds get offered, and being there to hoover them up if there's a liquidity event, essentially. And a liquidity event not being a sale or something good. A liquidity event is usually something bad that results in lots of selling pressure, which means that you can buy the bonds at will.
And what would you say would be the key aspect from that experience that then shaped your microcap investing strategy? What was the one thing you took away where you're like, okay, I need to be doing more of this?
I'm not sure that it shaped it. Ultimately, that was my first job in the industry, and I've learned a lot since then. I just think very early it kept me from being afraid of illiquidity, and it kept me from being afraid of leverage. And I think a lot of equity investors, especially at the beginning of their career, are hyper focused on both those things, with good reason, but they aren't a certain cause for rejection if a company is highly leveraged or if it's a very thin stock. And I think, for lots of microcap investors, that's the area that we work in.
That's actually a really interesting idea because, one thing that I'd say amongst those who I've interviewed on the podcast, they would definitely go against that. They would agree with you in the sense that, they look for deals that aren't highly levered, no debt. Why aren't you scared of that? What about that? Just you're able to be like, okay, it's not that bad.
Well, I don't
obviously
love debt.
It depends on the deal, of course. I know, but
no, I would say two things. First of all, leverage is very much a problem in the small cap world, in the sense that if you're not in a position of power, a company with leverage on the verge of distress enables a management team to screw shareholders if they want to. And as you know, and as your listeners know, lots of microcap investing is about avoiding being screwed. But at the same time, when you
as in life,
yeah, when you do distressed debt investing and distressed investing, you intimately learn how debts can be restructured. And particularly, when I began in the business in the early 2000s, a lot of the great investments were basically, the great equity investments were basically deleveraging transactions. So you buy a big percentage of a stock that happens to be very cheap. And back then, you could have stocks that that were cheap, great businesses that were cheap solely because of the default risk, but then you could recapitalize the company as an equity holder and take that default risk off the table and then get an instant revaluation. And, we did lots of those kinds of transactions at my first job. Like the best example I can think of is, we did this, a private investment in a public equity for the company Denny's. And, we had bought
Full
a very big...
Are you still currently a shareholder?
No, I do not own Denny's.
Okay.
So we bought like a huge percentage of the stock when it was, I think, around 20 or 25 cents a share. The market cap, it was a tiny equity on top of a mountain of debt, and there was, there were rumored to be prepackaged bankruptcy talks and restructuring talks with the bondholders, and we basically bought a very big block of shares at pennies and then negotiated to infuse the company with capital. And that stock, it ultimately went over $12 per share.
So, moving forward here, I wanted to let my audience know that you also happen to do something, partake in a job that your very famous cousin Benjamin Gramm did as a professor at Columbia Business School, and again, that is a joke. They aren't actually cousins. It's a completely different spelling, But what's that experience like, or how are you able to translate what you've experienced in your life to your students?
With my class, we really try just to value a new company every week. I really try to teach the students to think about businesses like they're the gas station around the corner. That's the kind of mantra of the class. Like we say that on the first day of class, and every week it comes up at least once. And the thing with value investing, we all know the mantra of if you buy shares in a public company, then you're buying a fractional ownership, and you want to buy those at a margin of safety. Every value investing student at Columbia understands that in theory, but in practice, they still get seduced by the nature of the markets, into not actually thinking of stocks as those fractional ownerships. And so, even though we all claim that is what we do, so few people actually do it. And so, the real point of my class is to teach the students how to think about business, how to look at these companies every week and not focus on the stock price or the 52-week high or the 52-week low or a bunch of ratios, just on their own, like return on assets or return on equity. You're really trying to deconstruct the business, think about, the competitive dynamics, and think about, if you could buy the whole thing at this valuation, would you? And given that you can't buy the whole thing, are there control issues and governance, problems that you have to tend to? So, it seems very simple, but really lots of value investors still can cut corners at times, on that front, and can still think of stocks as, oh, this will bounce back, or, oh, the market is overreacting to this and the stock is going to pop, that kind of stuff.
One thing that I was curious, and you're probably the perfect person to ask this question to, because you talk with your students a lot, and when it comes to quantitative versus qualitative, you're
sure.
They walk in thinking, oh, just look at the quants, see what it's doing. This isn't interesting, Whereas you're trying to get them to take more of a qualitative approach. Why do you think that that's the case, where, even after your class, maybe some students will still just, go by the quantitative approach and not take a deeper dive into the qualitative? Is it because it's just a lot more work, or, what do you think?
Yeah, that's a very good question. And to be clear, I don't know the answer, but I think a lot of it is a little bit intellectual laziness. And there's a beauty to the idea of all I need to do is just, we'll plug this into my spreadsheet and it spits out the valuation. And the primary problem that I've had with a lot of my students is, it's not that they're not smart or that they don't get it. It's that they do, tend to have some tunnel vision, to not think all that clearly about a lot of these issues, and not to kind of take a step back and think big picture. And so, you'd be surprised at how often we'll look at a company where the students have not actually read every page of the 10K and thought about the history of the business, of how it got to where it is, that kind of stuff. And all those things inform you about, the true nature of it, how they make money, how they might or might not have a competitive advantage in their lines of business.
Mm-hmm. So just as the full recap for this first part of the interview, because
sure.
I did want to provide, my audience a good understanding as to, how you approach microcap investing in your strategy. What are some of your key criteria that you look for when assessing a potential microcap investment?
Yeah, I just I look at the business, I try to understand it. Anytime that you do that, you're gonna have some questions that you don't know the answer to, and then you go out in the world and you try to find the people that know the answer to that question. So for me, the primary criterion is it a business that I can completely understand, and then is it a business that there's some clarity to the earnings stream, how confident can you be in a 1-year projection or a 2-year projection or a 3-year projection, and how durable is the competitive advantage that protects those earnings. Mm-hmm. And then when you understand those things, you can begin to think about valuation and governance and that kind of stuff.
Mm-hmm. That is a perfect segue to Dear Chairman,
mm-hmm.
especially when we're talking about governance. So Jeff, as most of you who are listening probably know, is the author of Dear Chairman, which I had the pleasure of reading. And Jeff, I loved it. Thank you so much for writing this book. One thing I wanted to ask about at first is, what was your impetus for writing this book?
I really didn't have a good reason. I had the idea. I knew that it was a good idea. I like to think that I have, a pretty good chops as a writer. And then, as I tell people, just enough good things have happened in the process to push along a project that honestly, 9 times out of 10, I would have dropped it. I might tend to have a lot of ideas, and I tend to not come through with most of them. and with this one, it was just enough things happened at the right time. And the key moments were when I got the Ross Perot letters and the Warren Buffett letter, and then when I got a book agent, and then when I signed a book deal where they pay you in advance and you have a firm deadline. It was those events really made the thing happen, where my original plan was just to write the book and hope that Columbia Business School would publish it. And I think if I had gone forward with that idea for the project, that I would have never finished. I didn't have time to do it in the first place, so I really needed that deadline. As far as why did I have the idea in terms of impetus, I'm interested in public companies. I like history. It seemed like a fun thing to do, but I don't. Yeah, to me, in lots of ways, it was a bunch of lucky events that resulted in in a finished book. Mm-hmm. There was a lot less of a master plan than you might think.
And what's interesting is that it's, and this is no comment on how it reads itself, but it seems that each chapter you found a really interesting story, and you were like, you know what, I'm just going to dig deeper into this because I want to understand what actually happened. And it so happened that you just found one story after another, and you're like, wow, there actually happens to be there's a connection here. This I'm going to make it a book.
Yeah, no, I mean, it was a real fun project. And yeah, like when people ask about like, well, who's the target audience? Is it, for business school students and yeah, like it really was about just like a book that I would want to read. And so in a weird way, it's, kind of targeted for like, value investing fund managers. But that was, I mean, like the only way to really get that thing done and to make it happen is that it was extremely fun to do. So like I had to write for myself,
Right. Now, by the way, for full disclosure, I pointed at myself when he said, who's the target audience, and it's a.
What has been interesting about it is it's not actually a value investing book. It's a book about corporate governance, but the community that has latched onto it the most by far are the value investors, and it has not gained a lot of traction at all among the governance community. So it definitely, resonated the most with the people that are like me.
Don't worry, I'm sending this interview right to Adam Epstein, who I did an interview with for episode 22. I let him know. I said, dude, I'm doing an interview with Jeff and Dear Chairman. He's like, oh, you got to send that over. So shout out to Adam. Hello. And that's interesting that you say that, because it does tie into as a value investor, when you're talking about qualitative due diligence, you really want to have as much information at your disposal as possible. And it seems that this is a good characterization as to what can happen on these public company boards that you should pay attention to, because it could have a negative effect on an investment that you otherwise might think, oh, this is interesting. So, right?
Yeah, and I think it's important stuff, and I think as an investor, it's important to understand the way that the boardroom works. But yeah, I mean, like at the same time, it was like, how do you take a book and talk about these inherently extremely boring concepts, but do it in a way that it's entertaining? And in a sense, I just got extremely lucky because I had Ross Perot and Ben Graham and Buffett and Dan Loeb and Carl Icahn, these guys who are inherently extremely entertaining, and I got to use their stories to make it all hum.
I wanted to quickly define what is shareholder activism. For those who don't know, and the book itself, it really talks about the rise of this concept within the American financial community. So for you, what does this concept mean? How do you define it?
Well, as I talk about it in the book, I mean, ultimately, shareholder activism is, nothing fancier than when shareholders in a public, company either begin to kind of exert their rights, to appoint directors, or when they just try to intervene in the direction of the company with advice or threats. So activism itself is, nothing more than engagement, and the book is ultimately less about the evolution of activism and activists, because throughout the whole book, the activists are just these pretty consistent economic actors out to make a buck. The book is a lot about the way that governance has evolved. It's a lot about the way the passive shareholder base of public companies has evolved, and the kind of the key issues with that. It has a lot to do with the goals of a public company, if a profits should be the primary goal, that kind of stuff. And so it's called The Rise of Shareholder Activism, but it's also about the reason that the rise happened and what it has wrought.
Would you say there's a difference in shareholder activism between large caps and micro caps? The book mostly covers large caps. So, I guess compared to your experience versus what you research, is there a difference?
Yeah, I think there's a pretty big difference. I mean, I think in large caps that you tend to have a concentrated shareholder base, but not hyper concentrated, and it tends to be a collection of these sophisticated passive investors. In the microcap space, often if you're looking at a $30 million company or a $50 million company, there's a couple of key holders, and so activism in the big cap space is a lot about persuading the big institutions that hold the voting shares, and so it's very much a game of persuasion. It's a political game. That's the reason that a lot of the famous activists are are political animals, and they're very smooth and presentable. In the microcap space, it's a lot about leverage and control of the big blocks of shares, and so you see more reward for the hyper aggressive, and and often it's just about convincing a very small handful of shareholders, that you have the right ideas to move the company forward.
So one prevailing theme that each activist observed is that the management ownership of the company was not in line with the interests of the shareholders. Specifically CEOs owning a very small percentage of the business. Is this something that still persists as a reason for an activist, a potential activist campaign? Even if a company is being run well, does that leave the operator vulnerable?
Yeah, I mean, it definitely persists still. I think that that everyone that invests in microcaps and listens to your show has come across situations of a poorly run public company where the CEO and the board does not own lots of shares, and so there's not lots of accountability, to them, and they don't have a lot to lose if they make bad decisions. So I think that it's a very common thing to see that misalignment, But I would go a step further and say, even if a CEO or a board of directors owns a lot of shares, just by virtue of being on the inside, they don't have exactly the same alignments. And, you see lots of people in microcap land, will really fixate on, is the CEO aligned with me? Is the board of directors aligned with me? And that's important in a broad sense, but they're never going to be, perfectly aligned. And if you ever hear a stock pitch that's the alignment is perfect, that's not completely true. It cannot be 100% true. And there are lots of examples where a big shareholder can do something to hurt the other shareholders, even when they're perched in the CEO seat. So, we talked about earlier, distressed investing. It's if the company's in distress and you're a good CEO who owns a lot of shares in the company, it's easy to put that thing through bankruptcy and to come out the other side with the same level of share ownership. But a lot of times, when that happens, the outside shareholders don't get the same deal. So there are lots of ways that you can seem aligned on paper and still get hosed. So you always have to be careful in just assuming that they own a lot of shares and so it's a perfect alignment.
So you really want to look out for it. From what I gathered from that is you want to make sure more so, not so much that the share ownership is aligned with management and shareholders, but more so that whatever the CEO or management is saying that they'd like to accomplish is in line with how you foresee the business going. Would you say that's more of something to look out for?
Yeah, I mean, they're both important, but the main thing is that you have to trust them. I mean, ultimately, a lot of corporate governance is about trust, and it's about, if you believe that in the long term that they're going to treat you right. And to the extent that you can't, rely on trust, it's great if you can have a big stick in your back pocket, which in the microcap, world would come from being a big shareholder that could push their way into the boardroom if they had to. Or just like being in a company where the structure allows that to happen. It's always a lot harder if you're invested in a microcap where control of the company is already spoken for, right? Like if you're investing in a controlled entity, it's a matter of trust, and you have no leverage to improve things if the trust is broken.
Mm-hmm. So now getting to specifically in the book, there's a quote that you mentioned in there where you were quoting somebody else, and it states, and I quote, "If shareholders continue to be passive, they will continue to shorn like sheep." Especially with microcaps, while CEOs are much more accessible, where do you draw the line between passive and active? I've heard many times from microcap CEOs like, gosh, if I took every investor call every minute, I would not be able to run my business. But at the same time, you want to encourage shareholders to be engaged, to find out as much information about, well, if they're a value investor, qualitative, to find out as much information about the business as possible. Where do you draw that line?
Yeah, I mean, it depends on the situation, but I mean, like, to back up a little bit, that quote, that was from a big institutional investor that had been invested in GM when GM bought, Ross Perot off of their board of directors for $750 million. And, what they were saying, and I mean, that was a big, turning point in corporate governance, like when these big passive institutions saw GM blow a tremendous amount of money to make their board worse. And they realized, like, oh my God, we have created this monster. And they basically, like, were saying, as long as we're completely checked out, these big companies are going to continue to take advantage of us. And I think the same thing applies in all levels of the market, like in the microcap space too. And like, that doesn't mean that you have to be on the phone every 6 weeks to the CEO to ask like a bunch of, nerdy questions about your model. It just means that you have to hold him accountable with your votes, or her accountable, and that you have to be an engaged shareholder to kind of to help the system, work as good as it can.
Mm-hmm.
But just like for me, like in terms of how engaged am I with the companies that that we own, it very much depends. It depends on the nature of the company. It depends on, I mean, like there are companies that we basically have not talked to in a couple of years.
I think there's some people who are listening who would be like, a couple of years? Oh my God. But
they might be right. Like, you never know. Like, I should get on the phone.
I'm sorry to whoever CEO is that you're invested in. You're about to be getting a call from Jeff very shortly. Anyway, so I wanted to another thing that you highlighted in going back to chapter 4 actually, mm-hmm. and it's this concept of and I'm using air quotes right now, is the poison pill.
Sure.
What exactly is that? And, in your opinion, do you see this as a key moment in the history of the rise of shareholder activism?
Well, the poison pill was essentially a legal mechanism to limit the number of shares in the company that a single shareholder could own. We don't have to get into the details of it, but basically it puts an ownership cap on the shares. And so, the main goal of that, was not to kind of prevent activism or prevent, takeovers, but it was to slow it down. So lots of takeovers in the early 80s, they were, what you would call these two-tier tenders, where like the buyer would tender for the first 51% at their best terms, and the remaining 49 would get worse terms. So that was like a real incentive as a shareholder. If you couldn't block the deal and you don't like participate in the first half of the tender, then like you only get the dregs. And like the poison pill was designed, by Marty Lipton as a way to kind of to slow down the, what he called the front-loaded tender. So, we're really, in terms of driving big change in activism and governance, I think the Ross Perot thing had a bigger impact. I think like the kind of the disenchantment of the passive investors, not just from Perot, but from the corporate raiders and from Greenmail, had a big impact. And like there were some changes on the regulatory front, like Delaware 203, things like that. But the poison pill, I mean, it's in place at a lot of companies now. Like it was like in place at a lot in the 80s. Like it doesn't prevent activism or takeovers. It's like it slows down activism, which, like if you're an activist and you have the right ideas, isn't that much of an impediment.
Mm-hmm. So, in going back to chapter 5, you also highlight how institutions started taking more of that active approach with their holdings. Mm-hmm. In your opinion, how has the awakening of institutional investors impacted public company governance? And is there a fundamental difference then from individual shareholders?
Yeah, I mean, the main thing is, this like huge percentage of the shareholder base are these big passive institutions, and the fact that they're checked in now, it means there's a lot of accountability in the system. That if you're a director of a big public company, like you're thinking about activists, you're thinking about if your shareholders are happy, and you're looking over your shoulder, and this whole thing has. It gave rise to this shareholder activism that is, so pervasive today. Like the reason that like these guys like Ackman and Value Act are in the headlines is like it's not that they're buying, controlling stakes in companies and taking control. Like they're, they're essentially, buying a modest stake, and they're persuading all the other big shareholders, and the big shareholders are a lot more, persuaded by activists than they were in the 70s and the 80s. And in a way, they are, not only permissive of activism, but they kind of have used the system to put themselves in the position of being, like the arbiters of activism. And lots of times, like the activists, like will be at the company, like involved in the company at their invitation. So, like they really do play a big role behind the scenes in the activism that you see today.
Mm-hmm. Based on the many examples that you gave in the book, what do you think is the best formula for a corporate board, and then also specifically for microcaps?
Yeah, well, like for boards, one of the big themes of the book is that, like, there kind of is no formula, and there kind of are no best practices. And, what you really want are directors that are engaged, that are checked in, like, that treat their job with, with loyalty to the company and the shareholders, and with a lot of care. And, to the extent of the governance in this country blows, like a lot of it is just because of that. It's just like the lack of engaged directors. So that's like the first step. It's not that they all need to own shares or that they all need to, like, have X credentials or Y credentials. It's that like they really need to commit some time to the job. And look, it's a hard job. And I sympathize with how hard it is as a director to do anything, like in the boardroom, to push a company forward. Like, the management controls all the information that you receive, and like you don't meet that often.
Like from chapter, I think it was chapter 4 with Carla, the
RP share,
over the family business, where she recognized, objectively you looked at the credentials for everybody that was on the board. it was stellar. You know,
Yeah.
they seem like it would be fine. Like that, this actually makes up a good board. But the problem was that there's a bit of too much familialness.
Yeah. Yeah. Well, that whole chapter, you know, that's a fun chapter. It's about Carla Scherer, who was the daughter of the founder of a company called RP Scherer, and her father passed away, and the CEO at the time the chapter begins is her husband. And over time, she figures out, you know, well, wait a second, I own all these shares. I'm not sure that my husband is actually, you know, doing the best job for my interest as a shareholder. And she decided, like, ultimately, like, to get on the boardroom and, like, eventually to put the company up for sale and to force a proxy fight to push out her husband. And that chapter is a lot of, like, about the board of directors, and it's like about, like, the way that directors are often, you know, kind of captured by the CEO that put them there in the first place. And that was a very good board on paper, but they were beholden to the CEO. And the people on that board who looked the least independent on paper were Carla and the chief operating officer. And it was those two who ended up being the dissidents and who ended up, you know, pushing the company to sell. And so that was like a real lesson that, you know, credentials are great, like experience is great, like all those things can help. But, you know, but ultimately that was like a board of experienced, you know, veteran guys that like were buddy with the CEO, and like were happy to to let him have his little fiefdom.
You know, each chapter in the book highlights a new era of shareholder activism. You know, in and you brought this up actually a little bit already. I can kind of tell, like, Ross Perot really had that chapter with GM really was very impactful for you. You know, but what would you say, you know, is the era that you learned the most from and had the greatest effect on how you approach investing currently?
I think the 1980s were the most fascinating and had the best characters and like the most, you know, what kind of change, you know, both in the markets and in, you know, public sentiment. Like a lot of that happened in the 1980s. And the big changes in the engagement of these passive investors, you know, that happened in the 80s too. So I really learned a lot from those three chapters, you know, Carla Scherer, Ross Perot, and the corporate raiders. In terms of my own investing, I came of age in that early 2000s of hedge fund activism. And that was like a very idealism-driven activism. Like you had like lots of loud people with extremely, you know, well, small sticks, you know, fighting these idealistic battles. I mean, like a lot of those, you know, those Bob Chapman fights, which I write about in the Daniel Loeb chapter, like a lot of those fights were against controlled entities, and he prevailed in lots of them. And that was like a real era of you know, trying to figure out, you know, like as a small but active shareholders, you know, what leverage did we actually have, you know, what could we actually get done? So, you know, that was when I learned to invest, and so like that era had the most impact on me.
Mm-hmm. And then, you know, how do you now see all of this evolving? You know, as I just asked, you know, each chapter, it seemed like it was the next stage in evolution of shareholder activism. You know, where do you see it going? How do you see it evolving?
I think that over time, these like the big passive guys will only get bigger, but they're going to be less passive. And like we've already seen some rumblings in that, like BlackRock in particular. Larry Fink has, you know, he writes an annual letter to S&P 500 CEOs, and he writes a lot about like, you know, are we ceding too much you know, power to the hedge funds? And I think like as good as it has been for them to be the arbiters and to not have to be the you know, like the heavies in these disputes. I think, more and more they're going to begin to do their own dirty work. And I think the first places that you will probably see that are in like the more like environmental, corporate responsibility, sustainability fronts. But I think that you'll see it in other areas too. So I think that's the next step, is for the Vanguards and the BlackRocks and the CalPERSes of the world, like to really, to essentially begin to put their own directors on boards. Like I think that'll ultimately happen. And I'm not saying that they'll just begin to, take control of public companies, but I think they will begin to have a bigger say in the composition of public company boards.
So what I ask this to everybody, and I'd love to get your opinion. What is your advice for new microcap investors?
My advice to them is, it's a great way to learn, right? It's a great way to learn about investing. It's a great way to learn. You learn a lot about governance, like the first 3 or 4 times that you get hosed by bad decisions, from a public company boardroom. So I guess that the things I would say is I would caution on overconcentration. I think that ultimately, if you're early in your career, don't get overly seduced by this idea of when you have a great idea, put half of your net worth in it, and that's the real way to make money. I think you're going to make mistakes in the early years, and a lot of them can be real gruesome. So you don't have to be hyper concentrated. And the second is, if you do get into activism, the thing that I tell people is, it's often good the first time that you do it that it's not your kind of a marquee position. It's not you're the biggest investment that you own and the one that you have talked about to all your friends, because in a funny way, activism involves trying to make a deal and compromising and doing all these things, which if you're too emotionally attached to the idea, or if you're too vested in winning, you might not get the best outcome. So for young fund managers, I often think it would be best if the first time that they did activism, it was not on their top holding, if it was on their second or third biggest holding. That might be that might be better. Mm-hmm. And talk to a good lawyer.
That's funny. I was gonna say I was gonna recommend your first advice being go buy the book. One, and then
please buy my book. It's an excellent book. So, it's also very cheap on Amazon right now. It's only $12. Crazy.
I think I paid more than that. So actually,
let's talk about that more. It's very cheap. No, I'm just kidding.
Yeah, I know. I was just gonna say. Real quick follow up to that last one. If you want to talk about it, I'm gonna ask. What can you describe an experience where you, as an activist, what was one that was very memorable for you that you learned the most? And you don't have to name the company. In fact, probably don't. But what was that? What was that experience? Can you tell me about it?
The biggest screwing?
Yes.
There's so many. I mean, there's a lot of of experiences that everyone will have. I feel like everyone will have the investment that their buddy who's extremely smart tells them about, and it's down 50% from where they bought it, and you can't quite get there if you do your own work, but you figure they're smart and you cut some corners, and then get hosed on it. And so that's one that everyone experiences, and it's a very good learning experience. The second one is the exact same as the first one, but replace the word buddy with high-profile, successful fund manager. And you'll see, some person that you respect a lot that will give a very articulate pitch on, it could be Richard Pizzina who was extremely good at these reversion to the mean investments, pounding the table that Freddie Mac was the best investment that he'd ever seen in his career, and I think that was in 2007. So that, what kind of investment. And then for sure the financial distress being like a way for management to kind of improve their position at the expense of shareholders. Like that's one that you see all the time, or if not the management team, like the debt holders. Financial distress is bad on the equity holders for the logical reason, because you're the last person in line, but it's also bad because it gets easier for you to get hosed, and the closer the company gets to bankruptcy, the less the board is working in your favor, and the more they begin to work for the debt holders. So that's a classic one.
How about as an activist yourself? When you've taken part in a campaign, like, can you describe one that you went through, maybe even recently, and like how you even got started doing it yourself, like, or what was the first time you had an activist campaign? What tell me about it. I'm just curious. I don't know if I'll ever do it in my life, but I'm just curious.
I think the first two boards I was on, we owned a lot of shares, but I was, essentially brought on, or like the beginning of the process of being brought on. Like I was essentially like being used as a pawn by, someone else that had an agenda. So on the first one, it devolved into a fight where we submitted a slate, like and that kind of stuff. But it began as we had bought a big stake, and the chairman, wanted to get like another person off the board, and so he, was encouraging of us, agitating, because he knew that he could use our agitations to get this other guy off the board. So the first few times, we were a little bit pawns in other people's games, and so that was always interesting. And then you kind of come onto the board, and there's already like a little bit of a power divide, or a little bit of battle lines essentially. And then with some later ones, it was I don't know. I mean, the boardroom is a great experience. I think that you learn a lot. You learn a lot about how decisions get made. It's hard. I mean, I don't think I'm very good at it. I'm not a good director. I'm not. It's hard to be I'm a good director as it is, but dispositionally, I'm more suited to finding cheap stocks than to being a a real hard ass in the boardroom. But in terms of the big lessons, I'd say that you learn your big lessons from investment mistakes. Like when you do activism, you learn a lot of little lessons, and they're each important in their own ways. But I can't think of any big, key fundamental lessons that I learned through activism. I'm sure there are some. I just can't think of them.
No, that's okay. I mean, at the end of the day, it just seems like a whole lot of politics. Just politicking nonstop.
It really is. It's factions develop, and I mean, even on a good board that is doing a lot. You kind of to get anything done, you have to get the critical mass of directors in favor of it, and you don't do that in the boardroom. You do it before the board meetings, and so lots of being on a board is talking to everyone else, developing a relationship with them, and for the hostile ones, you need to develop a good working relationship with them. So a lot of getting things done is on the phone between meetings.
Mm-hmm. This inspired a whole line of questions, because
sure.
Another thing I thought of is when you're let's not a passive investor, but let's say you're not actively engaged with the board, or you're not doing more activism-y things. How as an individual investor do you go about learning more about the corporate governance for a company, and understanding how the board works? Like what do you normally do?
Well, I haven't been that guy in so long. I would say probably your best bet for learning the dynamics of the boardroom, like if you're trying to figure that out, is probably going to be through one of the top 2 shareholders, because I think as an individual investor, you're more likely to get them on the phone with an accommodating vibe than the chairman of the board or a board member or the management. Just because if you think about it, like if you're an investor, like you're talking like to other investors, like when you call that big shareholder, like when you're just calling the chairman, they're not going to be that forthcoming about it, and
there's an inherent bias, you would think, too, right?
Yeah, and there's just nothing in it for them to share that information with you. I mean, like a lot of times when you're trying to gather information, it's kind of given to you because there's a reason to give it to you. It's not just we'll give it to you out of kindness. So if you hear about a dysfunctional board, it's usually because the person who thinks it's dysfunctional has a reason to tell people that. It's usually because they want your vote at some point. So like I say call everyone and learn what you can and try to develop a relationship with just a few of the people involved.
Mm-hmm. All right, Jeff. So this is my last question. I'll let you go.
All right.
So for my audience, where can they go and find more information about you, buy your book, and where can they potentially go see you speak?
All right. So if you go to dearchairman.com, there's like a lot of events on the events page. I love doing these book events. Like I just did one in Missouri with Brent Beshore. I'm doing one in DC at Comet Ping Pong with Chris Mayer from 100 Baggers. So like I like to do these events. If you're an organizer, like I'm happy to come talk to your hedge fund or your CFA chapter. The book is at its cheapest on Amazon. I guess that's the place to buy it if you're okay with the destruction of our culture. I'm just joking. And I'm on Twitter, Jeff_Gramm, and I have a website, dearchairman.com, and I'm hoping to write more and post an occasional deal book article or something like that. But besides that, I'm just here at the Bandera World Headquarters
in beautiful New York City.
In beautiful mud and snow-filled New York City.
And they can also see you at the upcoming MicroCap Leadership Summit as well, right?
That's right, in Chicago. And then I'm talking on Friday, St. Patrick's Day, at the MIT Investment Conference on March the 22nd. It's my kids' spring break, so we're going to Portland, Oregon, and Seattle. But I'm doing a book event at the CFA chapter in Portland on the 22nd of March.
Well, cool, man. Jeff, again, thank you so much for your time, and look forward to speaking with you again soon and seeing you at a future event.
Great, man. Well, thanks a lot.
Thank you.
Thanks. Bye.
Thank you all for tuning in to the Planet MicroCap Podcast, and thank you, Jeff, again for coming on to the program. You can access the podcast by going on to stocknewsnow.com under podcast, go to podbean.com and search Planet MicroCap Podcast, or on iTunes and search Planet MicroCap Podcast. Stay tuned for the next Planet MicroCap Podcast, where we'll have our next guest to discuss all things microcap. If you have any questions or comments about the podcast, please send an email to info@stocknewsnow.com. I'd love to hear from all of you. This podcast has been brought to you by SNN Incorporated, publishers of stocknewsnow.com, the official microcap news source, and the Microcap Review magazine. I'm your host, Robert Kraft, and thank you again for joining me on the Planet MicroCap Podcast. Have a great week, everyone.